You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way. Me, Sam Ball. It's the 10th of May, 2023, and I'm joined by my co-host, John McEwen. In this week's episode, we'll be discussing BP, Haleon, Shell, AB InBev, Trainline, and our US company of the week is Kraft Heinz. John, should I kick us off with BP?
Yeah, second largest oil super major this week.
Yes. So BP have come out with their first quarter results, and all these figures are reported in dollars. First quarter revenues were up from $49.3 billion to $56.2 billion, with the rise largely reflecting an exceptional performance from gas marketing and trading. Underlying replacement cost profit, BP's headline measure of profit from operations, was down 19.4% to $5 billion. The gas marketing and trading performance also fed through to profits, but it was not enough to offset lower oil and gas sales. Free cash flow fell from $5.3 billion to $4 billion, and net debt came in $6.2 billion lower at $21.2 billion. BP expects second quarter oil and gas sales to remain high, but sees lower refining margins across the industry. $2.2 billion of share buybacks were completed in the quarter, with a further $1.75 billion planned before the release of the second quarter results. A dividend of 6.61 cents per share was declared. BP, basically to maintain dividends, BP need the oil price to remain at they need the oil price to stay above just under about $60 per barrel. And at the moment, net debt is less than half forecasted cash profits. So that's not really concerning at all. And BP has said they think production restrictions by the world's leading oil-producing nations, combined with strengthening demand from China, will shore up commodity prices in the short term. In the UK, recently introduced UK Energy Profits Levy on North Sea operations saw the underlying tax rate increasing from 32% to 40% in the last quarter of 2022. In terms of valuation, the business trades at a forward P of 6.8, and that compares to a 10-year average of 12.3, and the prospective yield for the next 12 months is 4.1%. I think these results are fine, but the issue, and I say it every time, is that I have with these businesses is that results aren't really in their control. It does just depend to a large degree what the oil price is, which is why when they're performing very well, you do see them at these depressed valuations because it's not really sustainable. A lot of the increase in profits will be from an increase in the oil price. That being said, a forward P of 6.8, I think if you are optimistic about the future long-term price of oil, or even I guess medium term, that's pretty cheap. And the prospective yield of 4.1%, I think the effective yield is actually higher if you were to factor in buybacks, but that's just a pure dividend, which is a fairly decent yield. I just wouldn't invest in the industry. I think it's an industry that's in decline, and I will talk about it a little bit more when I cover Shell. But yeah, it's just not for me. I think it's cheap at the minute, but that largely depends on what you think the oil price is going to do. And then you're getting into macro calls, which is certainly not something I'm very good at. I struggle enough as it is with micro calls. So. John, what are your thoughts on these results and the valuation?
And certainly not bad. The oil price has come back a bit, and you're seeing that in the results. I think, again, I recently, or relatively recently, sold my Shell shares. And one of the things that I felt very uncomfortable with was with the amount of political interference, which we've seen particularly on the North Sea gas and the tax regime here in the UK with the windfall taxes, and then on top of that, subsequent windfall taxes, which has made me very uncomfortable, or did make me very uncomfortable, hence one of the reasons why I sold the shares. Very difficult to know where we are and where things are going from a macro perspective. Are we at peak oil? Possibly not. And you do still have the emerging markets and a big dependence on it. Renewables aren't there and they're very expensive. I know that doesn't necessarily correlate with what the price is going to be and the earnings then feeding through. I think too much uncertainty and too much political interference for me for either BP or Shell. But yeah, they're not expensive at the moment by conventional metrics. So difficult call, really.
Should we move on to probably a much simpler business in terms of it's not really relying on macro?
No, consumer staples, essentially. So Haleon is the consumer arm that was spun out of Glaxo, which owns brands like Sensodyne toothpaste, Panadol painkillers, Centrum vitamins. They had a trading statement out for the first quarter with revenue coming in at £3 billion, reflecting organic growth of 9.9%, which was largely driven by price rises of 7.1%, but volume mix also rose by 2.8%. Respiratory health was the biggest performing product category with organic revenue growth of 33%, helped by continued strong cold and flu season with recovery in China too. There's growth in all other categories, bar the vitamin and minerals supplements, which were down 3.7%, which faced strong comparatives due to the Omicron wave in early 2022. Adjusted operating profit was up 3.3% to £691 million, ignoring the impact of exchange rates. Growth was held back by higher costs not related to additional sales. Adjusted operating profit margin stood at 23.1%, and recently upgraded revenue guidance remains unchanged, with full-year organic growth expected to be close to 6%. Net debt stands at nearly £10 billion, with the group targeting net debt to adjusted EBITDA to be below 3 times by the end of 2024. In terms of valuations, Haleon has a market cap of £31 billion and trades at 18 times forward earnings. I thought these results were decent, particularly not dropping the volumes like we've seen with some of the other companies whilst they've been hiking the prices. Saying that, we've covered Haleon before. I think it's doing better than possibly we both expected. We've been a little bit down on it. I think particularly in the light of how much Unilever bid for it, which was about £50 billion in terms of market cap. So we're way off that at the moment. But these numbers were decent. The debt, again, we've talked about before, but that is coming down. I just don't think the margins and probably with the valuation, those brands, it would be one that I would be buying, but it's certainly made a more encouraging start to life. Sam, what are your thoughts on these numbers from Haleon?
The numbers are fine. They're pretty in line with our most recent regular episode, which was we did Unilever. What else? We did Nestle. We did Reckitt. But yeah, the results are in line. It's pretty expensive though. I think it's about the same range as like Unilever and Reckitt were. But I don't really like the brands as much. And the growth figures are not amazing. They're all right, but they're basically just inflation. And that, it's obviously one of the good things about these brands is they can grow in line with inflation. But how much above inflation is this going to grow? I don't really know. And I just think for a similar price, I'd much rather own the Unilever brands than the Haleon brands, which is one of the reasons I would have been quite disappointed if the Unilever acquisition had gone ahead, because I think in terms of the brands they were acquiring, I think it was dilutive in quality. Not to say that the brands weren't good, but I don't think they were as good as some of Unilever's top brands. I think the net debt to underlying cash profit target of below 3 by the end of 2024, that's pretty good. That would be at a level that I'd consider fine. But in the meantime, it's pretty expensive. And because a lot of the cash is going to pay off debt, the yield's only 1.7%. And again, at a similar valuation, you could get Unilever or you could get Reckitt, and you'd be getting a 3 or 4% yield. I think it's more like 3 at the minute because Unilever's gone up a fair bit. But you could get a significantly higher dividend yield from pretty much any of the other consumer goods companies that are available. So yeah, I think these results are decent, but they're not anything special compared to what we've seen from the others. I think it's quite pricey and the dividend yield's much lower. So yeah, that's where I'm at with it.
Yeah, fine. So neither of us are particularly interested in buying shares in Haleon. That's fine. So second and largest oil super major, Shell.
Yes. So Shell have come out with their first quarter results, as have BP. And again, these figures will be reported in dollars. Shell's first quarter revenue was up 3.3% year on year to $87 billion. Growth in renewables and energy solutions and upstream more than offset declines from integrated. However, revenues were sharply down from the fourth quarter of 2022, reflecting lower oil and gas prices, which we saw with BP. On a yearly basis, underlying earnings grew at a slightly faster rate than revenue, up 5.7% to $9.6 billion, and ahead of market expectations. Free cash flow totaled $9.9 billion, down by $0.6 billion. Shell ended the quarter with net debt of $44.2 billion, which was 8.8% lower than the same time last year. Overall, second quarter production levels and marketing sales volumes are expected to be broadly in line with the first quarter, as is refinery utilization. However, utilization rates of Shell's chemical manufacturing plants are expected to fall as it adapts to the low margins being seen at the moment. A first quarter dividend of 28.75 cents was announced, in line with last quarter. Shell also launched a $4 billion buyback to be completed by the end of July. Shell's renewables and energy segment is growing its top line, and this has been driven by a more than twofold expansion in renewable power generation capacity over 2022. Underlying earnings are still just a fraction of the group total for now. Shell's committed to achieving net zero by 2050, and that means reducing the group's emissions as well as those coming from the products they sell. Shell's strong financials enable it to self-fund significant organic investment and selective acquisitions such as the recent $2 billion takeover of biogas producer Nature Energy. I was reading one article as well that said, despite the progress being made in renewables, however, there remains a major threat that oil and gas groups in general risk the fate suffered by tobacco companies in terms of getting lower valuations because they don't meet ESG criteria. In terms of valuation, Shell trades at a forward PE of 6.4, and that compares to a 10-year average of 11.2, and the prospective yield is 4.6%. I think these results are fine. You can pretty much copy and paste my comments from BP. In terms of the valuation, it's pretty cheap at the minute, but it depends what you think the oil price is going to do. But what I don't like is I don't really like this idea that they need to get into renewables just because they're in energy. I understand that ideally the business would have a future, but I think if you're buying Shell shares, or if I was buying them, I would want to be buying an oil and gas company. If I wanted a renewables company, I would buy one. And I think, the article that I read that suggests that there's a threat that they could be treated as if they're tobacco companies. I mean, a forward PE of 6.4, genuinely, what is the difference already? Because those are tobacco valuations already. I don't think all this green energy stuff is actually going to change it. It's always going to be an oil company in people's eyes. And I think just do what the shareholders want you to do, or what they're buying the shares for. Distribute, do buybacks, do decent dividends, distribute the cash for as long as you can. And if investors want to take that cash and invest it in oil and gas, in renewables, they can. That's not your job. Well, it's just not your job. It's not quite as bad, but it's similar to like tobacco companies, isn't it? In the 1970s and 80s, when you read Going Down Tobacco Road. But yeah, I just think it's just silly. And to do it as well, because you might get a better valuation. And in terms of, like from ESG scores and stuff, I just kind of think, well, if you're the management team of Shell or BP, you're being paid to run a business. You're not being paid to manage a stock price. I think just run the business in the best way possible, in the best interest of the shareholders. I think that is by making as much money from oil and gas as you can. So I wouldn't invest anyway. There's also the exact same political concerns that you gave. So yeah, just definitely not for me. John, your thoughts as a former shareholder?
Pretty much the same, and some of those reasons are why I did sell. I try not to look at the share price, but it is lower than what I sold it for relatively recently, so I'm happy about that. But no, the fundamental reasons why I sold haven't changed, so the psychology of the share price, again, shouldn't come into it.
I think that's a comment more directed at yourself than the listeners.
True. It's but an investing lesson, I think, or one that I've learned, because you do get anchored, and I'm guilty of that.
Right,
It's one of the few shares I've actually sold for that reason. But
never
anyway,
sell shell.
that's what they say. So again, don't look at the share price again if you do. AB InBev. So we have covered it on the show before. It's the owner of Budweiser, Stella Artois, Corona, world's biggest brewer. They had their first quarter results out with revenue up 13.2% on an organic basis to $14.2 billion. This was mainly driven by price hikes, but volumes also crept up by 0.9%. And $100 million was actually generated by their direct-to-consumer ecosystem. Revenues grew across all of the geographies, and the ongoing premiumization trend continued. It's very similar to Diageo in that respect. The group also delivered over 30% revenue growth on their non-alcoholic beers, whilst the mainstream beers gained market share in 75% of their key markets. Underlying operating profit grew 14.9% to $3.5 billion as revenue growth outstripped the rising operating costs. Full-year cash profits, EBITDA, is expected to grow by between 4% and 8%, with revenue growth expected to be ahead of that level. In terms of valuation, AB InBev has a market cap of 111 billion euros and trades at nearly 19 times forward earnings, with a prospective dividend yield of just under 2%. Again, I thought these results were decent, particularly with volumes not dropping off despite the price rises. I do like the premiumization strategy, particularly with people in the West drinking less. And it's something that's worked well for Diageo that we've seen. I'm not sure whether you can have the scope to hike quite like you would with a premium spirit, because they, at the end of the day, they are just sort of beers. But they're very strong brands in the portfolio nonetheless. I suppose one of the big issues, and something that we've again come across before with when we've covered AB InBev, is that the debt is very high and is at 3.5 times cash profit. I do like the company, but that is my main issue with it. Also, it's not cheap. I feel like I've got Diageo in my portfolio, so I wouldn't, and I think that's a higher quality company, so I wouldn't really be looking down to AB InBev. And that's kind of where I am really with it. I think if the debt were paid down, it would, possibly move to my watch list. It's not one that's immediately there now. Sam, what are your thoughts with these results from AB InBev?
I think the results are pretty good. I think 13% is good. I know it's not quite the same, but if we compare it to the consumer goods companies that we've covered in the last couple of weeks, it's one of the better ones. I appreciate it's not directly comparable. Debt 3.5 times cash profits, though. It's in that range. I'd say once you get from 3.5 to 4, it's uncomfortable. And then above 4, it starts to move from uncomfortable to uninvestable, I think. For me, it does. So that's not great. I agree with what you say about Diageo being better. But I think to increase prices and have volumes increase at the same time, that is good. But in terms of the price, forward P of 18.7, I think it's quite expensive. The dividend yield's quite low. And it's just not a stock I think I'd really want to own, to be honest. It's just not for me. It doesn't really excite me. I know that the best investments don't need to excite you, but I'd just much rather own Diageo's brands. And I know you have to pay up for them.
One thing to say for it, though, is emerging markets exposure, and that while we do talk about people drinking less in the West, there is sort of volume growth there in the emerging markets where they're not saturated like they are, for example, in North America. Also, I suppose there's that non-alcoholic beers that's growing pretty rapidly, but still a much smaller proportion of revenue. So there may be a couple of the more positive things there. But yeah, I don't think it's for either of us at the moment.
No. Should we move on to another one that's probably not for either of us?
Oh, yeah. Go on, Sam. Trainline.
So Trainline, it's one we have covered a few times before. They have come out with for anyone who's not, I assume if you live in the UK, you're familiar with it, but it's an app that you can use to buy train tickets. They have come out with their full year results, and net ticket sales were up 72% to 4.3 billion. However, still up against easy comparatives. If you compare them to 2020 rather than 2022, they're up 16%, which is still, fairly decent, considering we've been through a pandemic in the meantime. Revenue was up 74%, 327 million for the year, but 25% for 3 years. Operating profit moved from a 10 million loss to a 28 million profit, and that's up from a 2 million profit in 2020. And earnings per share moved from a 2.5p loss to a 4.5p earnings per share, and that's up from 17.7p in 2020. In the strategic highlights, they've highlighted strong growth in Spain as routes liberalised, with a fourfold increase in net ticket sales in over 3 years. They've said they're growing brand awareness with a new app customer acquisition in Italy, helping triple net ticket sales over 3 years. They've almost doubled foreign travel sales over 3 years, with particularly strong growth to US inbound customers. They've doubled the UK commuter segment share over 3 years, including 4 million customer setups of favourites journeys, personalisation features, and good early demand for digital season tickets. They've said the focus on commuters and digital rail cards in the UK is helping drive up customer transaction frequency. Half of active monthly customers are transacting over 2 times per month, or 2+ times per month. They've signed carrier IT contract solutions with ScotRail and Cross Country, and signed up third-party retailer Trainhugger as a new client. They've accelerated delivery of product innovation, launching Prix Fruits, Split Save in France, Trenitalia discount codes in Italy, and quick buy repeat purchasing in the UK. And they've also highlighted the I Came by Train sustainability campaign, which has become a galvanising force in UK rail, with Trainline partnering with the UK government and rail industry to make the environmental case for rail. For the next year, they say that following strong growth in 2023 and a positive start to the current financial year, they expect to generate, for the 2024 year, which they've now entered, net ticket sales growth in the range of 13 to 22%, and the same for revenue. In the slides, they've pointed out that the international consumer segment became a €1 billion net ticket sales business, and that's on total revenue of 4.3 billion. And in the UK, they highlighted that industry recovery was slowed by strike action, with 30 strike days between June 22 and March 23. And then the gross sales impact per strike day is £5 to £6 million. So next time the rail workers go on strike, spare a thought for poor old Trainline, whose pre-strike numbers weren't even fantastic, it has to be said. Passenger volumes are back to above 90% of pre-COVID levels. In terms of valuation, the business trades at a P ratio of about 35. I thought these results were actually pretty good. It's benefited from easy comparatives, but even compared to the 2020, the pre-COVID results, it's now up. However, one concern we've repeatedly stressed with this is I do feel that if this business performs too well, and we get, for example, a Labour government come in, it's just going to get nationalised. And maybe that's unlikely, but it would be a concern for me. And I think it's pretty expensive as well. I know that it's now basically back to pre-COVID levels. I don't think long-term there's going to be huge changes in the amount of people travelling by train, although they do seem to keep managing to increase the fees every year. But if they also want more people travelling by train for environmental reasons, they probably can't carry on increasing prices like they have been doing in recent years at the same time. So yeah, a P of 35, I just think it's very, very expensive for the figures it's put up. Even before COVID, I think we covered it a few years ago when we first started doing the show. And even its pre-COVID numbers, the growth's not fantastic. And I don't think it anywhere near justifies the 35 PE ratio. So yeah, interesting business to cover, but it's just, there's various reasons why I would just not touch it. John, what are your thoughts on the results in the business?
Yeah, similar. I mean, we've covered it before, and we've been through different leaders politically. I think it's that great uncertainty that does hang over it, and it's quite a populist policy to renationalise. I guess they kind of are, but renationalising the railways, and then this type of operator, I think is ripe for it. And the better it does, the greater the calls would come for it. Similarly to BP and Shell in terms of windfall taxes. So fundamentally, I wouldn't go beyond that, even if it were doing better than it is. I don't think it would be investable.
And then you've got the valuation.
Oh well, yeah. I mean, I wouldn't even get as far as a valuation, really. But yeah, that's where I'd leave it.
Right. Well, should we move back to consumer goods?
Oh, yes. And that was, turning into another consumer goods special. So Kraft Heinz is our US company of the week, owner of Heinz Baked Beans, ketchup, Philadelphia, Jell-O, Kraft, mac and cheese, and it's got hundreds of other brands, albeit they're more popular in the US than they are over here, and that's their major market. But anyway, they had their first quarter results out with net sales up 7.3% to $6.5 billion and organic net sales growth up 9.4%. This was a result of price increases of 14.7%, with volume mix declining 5.3%. Gross profit margin grew by 62 basis points to 32.6%. And adjusted EBITDA grew 10.3% to $1.5 billion, with higher pricing and efficiency helping offset higher supply chain costs, a fall in the volume mix, and higher commodity prices, alongside unfavourable foreign currency movements. Diluted earnings per share were 68 cents, which was up 7.9%. And in terms of geographies, North America saw net sales grow 6.2% to $4.8 billion, while international grew 11.1% to $1.6 billion. Year-to-date, free cash flow came in at $220 million, down 19% versus the prior year period as a result of increased capital expenditure. Going forward, the group has reaffirmed its expectation of full-year net sales growth of between 4% and 6%, and adjusted EBITDA of between 4% and 6% at constant currency. Meanwhile, adjusted gross profit margin is expected to grow between 125 and 175 basis points. In terms of valuation, Kraft Heinz has a market cap of around $50 billion and trades at 15 times forward earnings. I didn't think these results were bad. However, it is disappointing to see the volume mix declining 5.3%. And as with the other two companies, Haleon and AB InBev, that we've looked at this week, you didn't see that, although I guess these price increases were on the higher side. It's a long-term recovery story with Kraft Heinz, and I do think they're going in the right direction. It's certainly a much healthier company with the debt coming down since in the 4 years that I've owned Kraft Heinz, and I'm happy with the direction it's going in. It is investing in those brands, and we see that with the free cash flow going down in some of the core brands, which I think perhaps a few years ago had been written off a little bit, and there was more emphasis on sort of acquisitions and buying some new trendy brands that didn't really pay off. But sort of going back to basics seems to be part of the basis for that long-term turnaround with Kraft Heinz. It does trade at a discount compared with some of its peers like Unilever and like Nestle. And I do appreciate that the results aren't there yet. But I think with the portfolio and the way it's reinvesting in those brands, it won't be that long before we get back to that, and then ultimately seeing the earnings really taking off then, possibly, well, I hope a re-rating in the share price, but that's yet to be seen. Its yield is around 4%, so it's fairly decent. Sam, what are your thoughts on Kraft Heinz? Would you like to be a shareholder too?
Probably not for me.
I thought you might say that.
The price increases were quite aggressive.
Yeah.
Now, they have increased revenue by a pretty good amount, though, but it's at the cost of volumes. But I do like a lot of the brands. I've got some quality brands. Obviously, Heinz is just a fantastic brand. But, some quality brands, it's really unusual to see a company like this trading cheaper than its UK listed equivalents. I can't think of another industry where you'd get that. I know this isn't an industry-wide thing because Kraft Heinz has had its own problems in recent years. And I know we've covered McCormick before, the spice maker, and that was trading about 35 times earnings or something stupid. And equally, we've covered Coca-Cola and Pepsi, which are US listed, and they are much higher. But I think a forward PE of 15, cheaper than Unilever, cheaper than Reckitt, cheaper than Haleon. I think Kraft, for me, is the only one that actually has brands that are on the same level as Unilever's. And it's the cheapest one. The dividend yield's pretty good at almost 4%. You compare that to Haleon, we were looking at like 1.7%. I think of the consumer goods companies we've covered in the last couple of weeks, if I had to buy one, gun to my head, it would be Kraft Heinz, mainly because of valuation. But yeah, I think these are decent results. They need to be careful with the price increases because they are not a tobacco company. They cannot raise prices indefinitely at the levels they have been. But yeah, I think they're decent results. And I think it's a pretty good valuation.
They're coming out with frozen mac and cheese soon.
Oh, well, the world's been crying out for that.
Yeah, exactly. Exactly. But so we'll see. It's definitely a turnaround story. And with the collapse in the share price, was about 4 years ago, and the big write-down that they took then. It's been interesting to play out. But it's one of those slow stories. It's certainly not a quick turnaround.
No. So of the 6 businesses we've covered this week, BP, Haleon, Shell, AB InBev, Trainline, and Kraft Heinz, if you had to buy one, which one would it be?
It would be the one that I already own, and it would be Kraft Heinz.
I would also go with Kraft Heinz, although I wouldn't really like to own any of the others. So it's more by process of elimination this week. But although AB InBev's it's not a bad business, although the debt's a little high. Yeah, it is Kraft Heinz by process of elimination, actually. So yeah, I think that's everything in that case.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.